Welcome to PIMCO Pod. In this episode, we discuss why shifting labor market dynamics are keeping U.S. wage growth subdued despite falling unemployment. Stay tuned after the conclusion of the podcast for additional important information. Counterintuitive Labor Market Shifts Constrain Measured U.S. Wage Gains by Tiffany Wilding and Graham Westwood. The headline U.S. unemployment rate has been falling for several months, but a closer look at who is leaving the workforce and who isn't entering or returning to it reveals why average wages are stagnating and why labor markets aren't a source of inflationary pressure. In last week's edition of Macro Signposts, we discussed some counterintuitive trends in the U.S. labor market. Since the beginning of the year, we've seen tandem declines in both the unemployment rate and the employment-to-population ratio, a concurrence without historical precedent. See macro signposts: as older workers retire, labor costs ease. We argued that this trend is symptomatic of structural changes in the labor market related to demographics, AI, and immigration policy that are all colliding. The result is a labor market that isn't as tight as the headline unemployment rate alone, 4.1% as of July 2026, according to the U.S. Bureau of Labor Statistics, BLS, would suggest. The fact that the unemployment rate is falling while reported wage inflation is also falling confirms this. A tighter labor market theoretically is supposed to firm wage growth, not soften it. This week, we dig deeper into the BLS household survey data to better understand what is happening beneath the surface of those moderating headline wage trends. We find that a compositional shift in who is leaving employment and who isn't returning is pulling measured U.S. wage growth lower even as the jobless rate declines. This shift, combined with rising labor force exits and a declining job-finding rate, paints a picture of a labor market that is not generating a sustained source of inflationary pressure. Given that labor costs are a large portion of the input costs for the goods and services produced across the U.S. economy, consumer price inflation, which is now elevated, should converge to labor cost trends over time. These labor market trends also argue for central bankers not to be overly reliant on the unemployment rate as a measure of the state of the U.S. labor market. Why falling unemployment and slowing wage growth don't typically coincide. Standard economic theory argues that wage growth slows when unemployment rises and firms when it falls. In good economic times, stronger hiring rates reduce the available number of individuals searching for jobs and force employers to compete harder for scarcer workers by bidding up pay. On the flip side, recessionary conditions with rising unemployment rates and unutilized labor supply tend to be associated with falling wage inflation. The recent decline in the U.S. unemployment rate paired with falling labor supply and decelerating wage inflation challenges this traditional logic and adds to the confusing signals coming from the labor market. The key to understanding why this is happening lies in the way aggregate wage measures are actually constructed. Average wage growth compares the mean wage, or median wage, depending on the measure, across the workforce in one time period to a later period. That number blends two very different things: the raw pay changes of people employed in both periods and the compositional effect of who moved into versus out of employment in between. Because these two activities tend to behave differently over the cycle, the aggregate wage numbers can diverge sharply from what's happening to any individual worker's paycheck. The household survey's gross flows, transitions data let us see this directly. Each month, workers move between 3 states relative to full-time employment, unemployment, part-time work, and out of the labor force, and the wage level of those movers matters enormously. Historically, entrants, those who secured full-time work, from formerly being part-time employed, unemployed, or outside the labor market entirely, think of a recent college graduate who secured his or her first job outside of school, overwhelmingly come in below the average and median wage, roughly 70 to 80% due, according to research by Daly, Hobogen, and Pyle, and our own calculations based on household survey data. This is why hot labor markets that pull people back after a period of not working or not looking for a job still tend to have moderate wage growth. The wages of people who remain employed grow faster than the aggregate wage measures, which are being pulled down by a shift in marginal hiring wages that are below the median wage. Exits from employment work in a similar way. Individuals transitioning out of full-time work tend to be at wages below the median and average levels. This is why, in a typical recession, aggregate wages hold up better than you might expect. The workers exiting employment are disproportionately lower paid, service sector employees, so their departure lifts the average wage of those who remain in the workforce, while collapsing hiring removes the low-wage entrants who usually would also weigh on the mean wage. Decomposition of average wage inflation as measured by the BLS Household Survey. The average hourly earnings measure is regularly reported, whereas the household survey measure must be calculated from the individual survey responses recorded each month. Both measures tend to track each other, but the benefit of the household survey is that aggregate average wages can be decomposed further to understand how compositional shifts are affecting measured wage inflation. What economists call the external margin is the net effect of compositional shifts in the makeup of employed people, the difference in wage levels between those entering versus those exiting the labor market. The internal margin is the change in the average wage of people who were employed and remained employed. As the chart suggests, a higher rate of people entering employment at lower wages when the economy is doing well tends to put downward pressure on the average wage. During recessions, for example the global financial crisis and the COVID pandemic, a greater share of lower-wage workers leaving the workforce tends to put counter-cyclical upward pressure on wages. Why the data are telling a very different story today. Similar to the recent behavior of other labor market indicators, this year's patterns in transitions into and out of employment and the compositional impact on wages are working in the opposite direction of what we've grown to expect. Rather than low-wage workers being pushed out, as is normally the case when labor market exits pick up, it is disproportionately higher-wage workers moving out of full-time employment into part-time roles, into unemployment, and most importantly, out of the labor force altogether, who are dragging down wage measures now. Indeed, because a larger percentage of these exits are occurring above the median wage, they are subtracting from average wage growth rather than propping it up. At the same time, the lower job-finding rates from both unemployment and outside the labor market imply we're not experiencing a wave of below-median entrants shifting the wage-level distribution toward lower-paying jobs, although a greater portion of the entrants that we have seen are below the average and median wage levels. In other words, it's complicated, and the net result is a compositional drag on measured wages that is occurring alongside falling labor supply. Through July of this year, workers transitioning from full-time to part-time employment have been the greatest drag on average earnings. Formerly, above-average wage workers are leaving full-time employment and transitioning to part-time. However, a rising share of individuals transitioning from employment to unemployment are people leaving what were relatively high-paying jobs. Signs of structural shifts in the labor market. All of these trends suggest that important structural shifts are affecting the U.S. labor market. Demographics and an aging workforce are colliding with changing immigration policy, broader economic uncertainty, and very likely the early effects of labor-displacing technologies, including AI. This has ushered in a wave of retirements among older, higher-income workers, which, coupled with increased transitions from full-time to part-time work at lower pay, is putting downward pressure on reported wage inflation. In addition, with prime age and college-educated individuals' job-finding rates also deteriorating, any waves of these individuals returning to employment that would normally pull up average wages also aren't materializing. Overall, the household survey's transitions data suggests that shifts in the labor market are weighing on aggregate labor income for households and costs for businesses. A disproportionate number of higher-paid individuals are leaving employment and even transitioning out of the labor market altogether. This has meant that the net effect of a labor market characterized by subdued hiring and firing rates is more moderate wage pressures. Policy implications. As we concluded last week, the takeaway for central bankers is to avoid over-reliance on any single labor market indicator. The unemployment rate is signaling tightness that the wage, unit labor cost, and workforce flows data flatly contradict. Labor is not a source of inflationary pressure in the U.S. monetary policy rules, data-based guidelines for setting interest rates, that are traditionally anchored to unemployment as a measure of economic slack, will prescribe monetary policy that is tighter than what a broader set of labor market data suggests is necessary. Thank you for listening. That was Counterintuitive Labor Market Shifts Constrain Measured U.S. Wage Gains. For future insights, please follow us on your favorite podcast platform. Macro Signposts highlights weekly takeaways from the data analysis conducted by our team of economists and other macro experts. For PIMCO's official views on the global economy, please visit PIMCO.com. This episode uses an AI-generated voice. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.